what we're going to be going over here is impairment testing for intangible assets. And what we're going to be comparing here is a limited life intangible versus an indefinite life intangible here when we're doing this impairment testing. Now with the limited life intangible asset, we're going to do both a fair value test and a recoverability test here. And with the indefinite life here, this is a intangible that goes into perpetuity here, we're only going to be looking at the fair value test here. So let's first go through the steps here that we would use to determine whether there is an impairment here. Number one, we review events or changes in circumstances for possible impairment. And in this case, we're going to be looking at the fair value here is going to be less than the book value here. And we're going to do this, we would be doing this for both the limited and the indefinite life intangibles. Now we get down to the second step here. And this is what we'd be doing here only for the limited life intangible and not for any indefinite life intangible asset. So two, we'd perform this recoverability test here. Now if the sum of the expected future cash flows undiscounted here is less than the carrying amount of the asset here, then we would have failed this test. Now again, future net cash flows less than the carrying value, then we'd be recognizing an impairment loss here. And then B here, if there would be no impairment here if the future net cash flows were greater than the carrying value. Now step 3 here, if the recoverability test here that we performed above here indicates that an impairment has occurred, then the loss is computed here. Now this is the impairment loss here. This is the amount by which the carrying amount exceeds the fair value. Now if the fair value is measured based on the market value here. Now if there's no active market here exists here for determining a fair value, then you would use the present value of the expected future cash flows here to determine the fair value. In any case, you're going to come up with your impairment loss here. That's going to be your carrying value minus your fair value here equals your impairment loss. So let's go look at our example here. Okay, just what we've got here is we're going to have a trade name that was we're going to have a trade name here, and it's going to be looking at it both here as an indefinite life here and a limited life here. And this is what we have here. It's determined at the beginning of 20x3 here. The fair value of this trade name is $32,000, and the future cash flows for the trade name is $34,000. And we're going to be looking at an impairment here. So this is for our example here. And what we do here with these in this case this intangible asset here as a trade name, when we're looking at an indefinite life, you have to remember here you do not amortize any indefinite life intangibles. So we're going to be looking at here first for our limited life case here where the trade name cost, let's just say it was $51,600, and we have an accumulated amortization here on it for the limited life here of this trade name here of $8,933. So we have a book or carrying value here of $42,667. Difference between its cost here less the accumulated amortization. And then we've also got our future net cash flows that we were given here at $34,000, and then we also have a fair value that we're given here on this trade name. It's intangible here of $32,000. So first thing, let's look at how we calculate our impairment loss here in both cases. Now with the limited life intangible here, you're going to have to do this recoverability test, and we're going to see that it fails here. So the future net cash flows are less than its carrying value. Future net cash flows were given here at $34,000, and it's less than the carrying value here of $42,667. So we're going to have failed this recoverability test. Now remember, the recoverability test is only done for the limited life intangible here. Now to calculate our impairment loss here for the limited life here, we have the book value, the carrying value here of $42,667. Remember, that's net, the cost net of any accumulated amortization. Now, and then we'd be subtracting or comparing it here, the fair value to the book value here. So we would subtract the fair value here of $32,000 from the book value, and we're going to come up with an impairment loss here of $10,667. Okay, now that's for our limited life intangible. Now for an indefinite life intangible, we take the book value or the carrying value here of $51,600. Now remember, with the indefinite life life intangibles, we don't amortize any of the cost here. So all we do is take what's sitting here at the book value here without any amortization here. And then again, we use the same fair value here amount here. We're given at $32,000. Subtracting that from our book value, we're going to come up with an impairment loss here of $19,600. Now this is for the indefinite life intangible here. So again, going back to our calculations here, loss on impairment, and that's the book value here minus its fair value, and I'm just looking at it here for the a limited life here at $10,667. Remember, the loss here for the indefinite life here would be $19,600. But in either case here, for both the limited life here and the indefinite life, we have a new carrying amount here of $32,000. Now that's equal to its fair value here. In either case, we have this new carrying amount that we have of $32,000. Now, if we expand this here for calculate our amortization expense here, again, this is only for the limited life here. Just say there was a useful life of 8 years left here. Divide that into the new carrying amount of $32,000. We're going to come up with an amortization expense here for the year here for each of the next 8 years here, $4,000 per year here. Now remember, only for the limited life here do we do this amortization here. Now let's go and look at our journal entries that we would have here. So again, what we would have capitalized here for this trade name here on our balance sheet. In both cases, we would have capitalized. Let's just say we had some legal costs here that we had, $36,000 for the beginning of the first year here, and then in the second year we had some legal defense costs here, $15,600. So in both cases here for the limited life and indefinite life, we would have capitalized that amount here, $51,600. Now, what we would have done here, let's first go talk about our new carrying value here. What we would do here with the new carrying value here, we would have, in both cases, for limited life and indefinite life, we would have debited our trade name or our capitalized amount here for this trade name at $32,000, the new fair value here. But now let's go and look at how we would have closed this out here on our balance sheet here. So what we would have done here, we would have taken the $51,600 here, debit amount, credited out here for $51,600. And then well, before we go on and record our loss here, we'll look at our accumulated amortization here. Now remember, that's for the limited life asset, only for the limited life asset here, not for the indefinite life. So we had an accumulated amortization account here. We would have credited it here, say for the first year here it was for $3,600, and then for the next year we would have calculated here at $5,333. Those are just amounts that I'm showing here that we've done. And so what we would have done here, we would have removed that off the books here when we recalculated it here, our impairment here. We would have taken this amount here on a credit amount, and we'd have debited it here for $8,933. Now remember, only for the limited life had we set up this accumulated amortization here. And just a note here, for 20x3 here, we would have added to our accumulated amortization here for $4,000 that we had for this year here we calculated, and then we would recognize it here on our income statement, a debit amount here for $4,000. Now let's go up here and look at our recording this loss here. So when we had this impairment, we record the loss here, and also we have to reset our carrying value here to the new carrying value. So for our loss here, first for our limited life here, we would have debited our loss account here. Anyway, we wouldn't have put both of these down here. I'm just saying one or the other here. So for the limited life, we would have debited our impairment loss here on our income statement again here for $10,667. And that balances with our other let's just say here we got debit of $10,667, and then we've got this debit amount here on our trade name here, the new carrying value of $32,000, and then the debit amount that we closed out and accumulated of $8,933. So you sum those up, and it balances with our credit amount here, closing out our impairment here on this capitalized amount we have of $51,600. Now if we go down here and we look at the second situation here with an indefinite life here, where we would have had an impairment loss of $19,600, that balances here a debit of $19,600 plus the debit here of our new carrying value of $32,000. That balances with a closeout here of our original capital amount here, $51,600. So this is how we'd recognize the for this impairment here. We'd have to recognize an impairment loss here, and for both situations, whatever how we calculated our loss here. And then we'd also have set a new carrying value here for this, in this case, the trade name here. Okay, and then one other thing that we want to talk about here. When we recorded this impairment loss here, and we may not recognize restoration here of any previously recognized impairment losses, even if the intangible value increases here for both the limited life and the indefinite life intangible assets. So whatever we had here for recognized as an impairment loss, we can't restore it here when we're dealing with these intangibles here. We just have to leave that on the book here. If it increases in value, well, then we wouldn't be restoring any of the impairment losses. So this is how we'd handle impairment testing for both the intangible and the tangible assets. So just remember here, with the limited life asset here, we had some amortization, whereas with the indefinite life you would not have amortized it. But in both cases we used the same, our new carrying value was the same for both limited life and indefinite life assets. But we'd have to calculate our impairment loss here based on, for the limited life, we had included here the amortization here when we figured out our impairment loss, whereas with the indefinite life we didn't have amortized it, so we wouldn't have any amortization expense included here in this impairment loss. All right, so that's just a summary here how you take care of impairment testing for intangible assets.